Hey, everybody, we are going to talk about some industries that we don't like and some stocks within those industries that we do. That might sound contradictory, but we'll explain. Before we get into it, please take a look at the link you see on your screen, fool.com/Frankel, for a message from my sponsor, The Motley Fool. It's the best way to support this work I am doing on YouTube, and you can get the top 10 stocks to buy right now. Again, that is fool.com/Frankel. So I guess I will go ahead and start with this one. One industry that I would generally avoid is hotels, specifically hotel real estate. Now, being a hotel operator or a hotel business can be good for the hotel brands, the Marriotts of the world, the Hiltons. Those can be very high margin businesses because a lot of people don't realize they don't own the properties. They are essentially a franchise company in a lot of ways. They don't even actually do the day to day operations in most of their hotels. They make sure the property matches with their brand standards and kind of lives up to expectations, things like that. Kind of creates a network of hotels. Um, but I'm talking about the companies that actually own the properties themselves. So if you want to look at, just real quick, I want to share a chart. This is a chart of four of the largest hotel operators or hotel real estate companies, their 10-year stock performance. So these are total returns. These include dividends. The best one, Host Hotels and Resorts, which happens to be the biggest hotel real estate investment trust, has produced a total return of under 30%, including dividends, over the past 10 years. So if you look at some of these other ones, Park Hotels and Resorts, Xenia Hotels and Resorts, which is a high-end hotel owner. They own a lot of these like really luxurious resorts. Negative 5% total return over a 10-year period. Yes, that included the COVID pandemic, which you see the effect of right here. But if you look before and after, it rebounded very fast. These stocks got to their pre-COVID levels for the most part within a pretty short amount of time. Look at Xenia's case; it reached its late 2019 level, by 2021 as tourism started coming back. So these have performed terrible. And there's one stock in this space that I like, and it's called Ryman Hospitality Properties. Let me add that to the chart. Ryman has returned 112% total return over the past decade. Not a stellar performance, but if you consider that they were probably the most affected of this group by the COVID pandemic, um, they are a group focused hotel operator. They own large scale properties. If you've ever seen one of the Gaylord hotels, those are Ryman's. They have six large scale hotels, including five of the six largest non gaming group hotel properties in the US. Massive amounts of convention space, lots of food and beverage outlets. One interesting fact is that Ryman makes less on average from its room rates than most of the companies you saw on that chart, but they generate 40% more revenue total per available room because of its convention space, because of its food and beverage outlets, because there are so many other things to do on its properties. And those are generally higher margin businesses than the rooms itself. Um, so, really interesting business. They've executed tremendously well. It's their average daily room rates have never been higher. Four of the five Gaylord properties saw revenue increase by double digits last year, and that's despite being a pretty tough comp to 2022, when the post-COVID surge of group hotel business really kind of started. So tough comp, but still is looking really well. A lot of growth potential on the hotel side of the business. I'll talk about the other side in a minute. Ryman is investing over $1 billion into its six properties by 2027. Some of them, quite frankly, are getting a little outdated, um, especially in the convention spaces. So they're adding new rooms to certain properties. The Gaylord Rockies, which is in Colorado, they're expanding it by 450 rooms. The Gaylord Palms, which is in the Orlando area, they're renovating over 1,400 rooms and the entire hotel lobby. So a lot of investment going on in the hotel side of the business to really try to unlock even more value out of that side of the business, while group hotel demand is very strong. You might as well take advantage. Then there's the entertainment side of the business. Ryman also has what the business called Opry Entertainment Group, that owns a couple of really iconic entertainment venues in the country music space. The Ryman Auditorium, which is where the company gets its name. It owns the Grand Ole Opry. It owns the Ole Red Entertainment venue chain. They just opened a brand new one on the Las Vegas Strip, right across from the Bellagio Fountains. Beautiful property, a lot of potential there. They're developing a big entertainment complex in Nashville. They're partnering with country star Luke Combs to do that. And the numbers from last year, I mentioned there's a lot of revenue growth going on. That didn't include any of that. The Las Vegas Ole Red just opened up in January. The Nashville Entertainment Complex is opening up later this year. And despite all that, Ryman is still kind of a cheap stock. It trades for about 14 times forward FFO, funds from operations, the real estate version of earnings. It could be a big winner as rates fall, because right now the real estate sector is kind of down in the dumps because they're very rate sensitive stocks. Ryman has done well in spite of that. It currently has about a 4% dividend yield, low FFO payout ratio. It's only paying out about 56% of what it's bringing in. That's low for a REIT. So I think this is still a cheap stock, one that I own, one that I plan to add to significantly. And it's the only company I would touch in the hotel real estate space. Tyler, what industry and stock are you looking at?
So the industry that, one that I've followed for a very, very long time, and I've just kind of come to the conclusion that I don't want to own an exploration and production oil and gas company. For all of the, I guess, appeal it would be for a lot of the oil and gas production companies, as of late in the past couple of years, they all found religion in the form of, free cash flow and actually generating enough cash to support their business, versus during the 2010s, we just had this weird period of go growth and basically eviscerated shareholder capital by taking out way too much debt to make things happen. But all in all, for all of the, better operations that most of the players in this industry have done, it still remains a business, or most of their investments or stocks, I guess if you will, are levered bets on the direction of oil price. No matter how good they are one way or the other, it just basically means, like, however oil prices are doing is how much your stock is going to go up or down. And with many of them implementing variable dividends, basically, like, look, if we got extra cash, we're going to give it to investors. With variable dividends like that, or policies, it's just more leverage to what oil prices do. And I just have no idea where oil prices are going to go. And because of that, it's just an industry that I don't want to do much with. And having said all that, it's time for me to now be a hypocrite and talk about the one oil and gas just pure exploration production company that I own, and that's Unit Corporation. And this is where we get really weird, right? Because I just talked about, this is a 400 million pink sheet company, thinly traded. Anybody who's watching this is one of those companies, when we talk about thinly traded pink sheet companies or trade over the counter, if you ever consider businesses like this, it doesn't have to be Unit, it could be any business like this, use limit order purchases when you make these purchases. Market orders for thinly traded stocks is a really, really bad idea. It just, the companies like this can have like $6,000-$7,000 worth of stock move in any given day, and it's not worth it to try to, I'm just going to buy my position. No, use limit orders. Otherwise, you could actually move the market yourself with a small order. But let's get back to Unit Corporation. $400 million company. Its oil and gas properties are, whatever. They're not great, and it's not like they're drilling a lot of shale today. Most of their investor presentations, they talk about maybe adding a couple wells, maybe a year. So, and it's not shale in the sense of, like, we're going to, you drill it and then it, 3 years later, it's practically gone dry because of, that's how shale goes. You get a lot really early, and then the production declines really fast. These are traditional wells, so they decline at much, much slower rates. They're very easy to operate. They just kind of spew cash for a long time without a lot of maintenance or operations. Uh, what to me makes this one particularly compelling is that on top of having an exploration and production company, they also own several drilling rigs, which yeah, they use it for their own, but not for much. But they mostly lease them out to other companies. They have a fleet of rigs that can handle the complex jobs that we see in the shale patch today. Those ones that can go down 2 miles, turn 90 degrees, and then go a couple miles to drill a frac well. So it has those rigs. It has that capability, and all of its rigs are currently contracted out, and so it's generating a considerable amount of cash from its contracted rig business. Um, you know, all in all, it's not anything spectacular. The thing to me that's so compelling is this is a $380 million market cap company with 70-80 million dollars of cash and short-term investments on the balance sheet. So we're talking, close to 25% of its entire business is in cash, and it's trading for a price to earnings ratio of 1.5, which I had to really dig into it because there's no way that it's selling for that cheap. And that's because, there was an asset sale built into it. But if we kind of normalize and back out asset sales on a normalized basis, it's still a stock trading for about 4 or 5 times earnings, which is incredibly cheap. And, I don't know where oil and gas prices are going to go, but I think that the environment for drilling natural gas, oil and gas in the United States is probably going to remain robust for at least a couple of years. And as long as that is in place, this is a business that's going to spew out a lot of cash and that has returned a lot of cash to its shareholders in recent years. It currently has a dividend yield of 12.8%, and it's a variable one, so it may not be the same come the end of the year. But if it's spewing out cash at the levels that it is, it's hard to see this not being at least an attractive income generator for at least a couple of years.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.